Hey everyone, welcome back to the channel. So in today's video, I'm going to share how I am investing in 2023. This is an exciting video. I've been thinking about making this for quite a while. So let's go ahead and get into it. Now, I'm going to talk about some of the funds I'm investing into, some of the individual stocks I'm investing into, which I typically don't really discuss on this channel. I don't like to get into the specifics on those. And then also some other areas that I'm putting money. Basically, when money comes in the door, where do I put it? How do I allocate it? And that's what I'm discussing in this video here today. Now, a couple of things before we get into it. Look, first of all, this is obviously not financial advice. I'm just a guy on the internet. So please, if you watch this video, don't go and just buy the things that I mentioned in this video because I could be totally wrong. All right, so looking back on 2022, it was a pretty good year. I mean, the portfolio was up quite a bit, but some years I'm down a lot. So last year we could chalk that one up to luck. But this year my goal is to really try to be a bit contrarian with my approach to how I invest. So basically when everyone's looking in one direction, maybe potentially look in the other direction, and you can find some potential alpha there or some really undiscovered value there. So the first point that I want to bring up is actually talking about some of the index funds that I used to have and how I kind of shifted some of those, basically reallocated some of that portfolio. This was a lot of the funds in my retirement account. So before I had a lot of S&P 500 and NASDAQ and Dow, basically index funds. And I kind of reallocated some of that and shifted a bit of it over to some emerging markets. And this is because I think and this is just a basic thesis here, but I think that emerging markets might outperform domestic markets in 2023. This is for a variety of factors, but if you look at what's happening right now with the Fed dialing up rates, they're pretty much, I think, about done. They're coming up on a 5% Fed funds rate. I don't think they're going to really go past that. So if you understand broad macroeconomics, then you'll know that when the US Fed, the Federal Reserve, is raising interest rates, we basically squeezed most of the rest of the world. And so we pushed our inflation onto the rest of the world. And the dollar got really strong last year in 2022. And I think that's kind of reversing. We've already seen it basically reversing in the past month or two, but I think it's going to continue to see that trend. And when the dollar gets weaker, emerging markets can really benefit from that. And so I think there's a potential for that, and I just want to have some exposure to emerging markets. This is, again, these are index funds, these are ETFs for a variety of other countries outside of the US, and just giving some diversification there. Because I see a lot of, the one thing I don't like is when pretty much everyone on finance YouTube or any like finance influencer will just tell everyone, go buy a S&P 500 and you'll make 7 to 10% per year and you'll be a millionaire when you're 65 years old or something. And this is kind of a bit of a bold statement perhaps, but I'm kind of a believer that the stock market in general doesn't really go up. It doesn't actually gain you very much. Basically what I mean by this is after you account for inflation, after you account for taxes, and you account for other things like country survivorship bias, that the stock market really doesn't grow very much. You might gain like 1 to 2% per year after you account for all those other different factors like taxes, inflation, and survivorship bias from that. Like the United States had great 100-year run, right? And it probably will continue to go up. But it's a concern that I have a bit. And so index funds, I don't like using for actually generating wealth for me. And I view index funds or broad like general market funds sort of as a way of wealth preservation rather than a way to build wealth. And just kind of keep that in mind as you go forward. So that's something that I did a bit of. I still do like funds in general when I just don't know what else to do with my money. It's probably better than putting it in cash. Of course, that's not financial advice. All right, now let's actually talk about some individual stocks that I have in my portfolio. So in the past couple of years, I've realized that I would rather have a very sort of concise, dense portfolio rather than having a number of different stocks. So when I was younger, when I first started investing, I used to have 30 or 40 different stocks in my portfolio. And I came to the conclusion that I actually only want to have at most 6 or 7 potentially 8 companies in my portfolio. I don't want more than that. And so I'll share some of them that are in my portfolio, the ones that I can that are large enough companies. But the reason why I made this big shift is because there was a time when, when I had 30 or 40 different companies in my stock portfolio where I would miss company earnings. I wouldn't even know what some of the companies were, or what this thesis was. Like, why did I buy JP Morgan last year? I don't remember. Did I have a thesis on that? Well, there's 40 other companies in my portfolio, and I end up kind of just forgetting and basically half-assing all these different investments. And so I don't like doing that. I like building a lot of conviction on specific companies and then going in a bit deeper on those companies. And that's just sort of my style. Some people would say there's a lot of risk in that. There certainly is, but I diversify outside of the stock market and other asset classes that I'll share in this video. But let me just share some of the companies that I have in my portfolio right now at the moment. So first of all, we have some of the dividend plays. Those are pretty boring. I'm not going to touch on them too much. Things like JP Morgan and Air Products, and some other things along those lines, right? And like Johnson & Johnson. Those are some basic ones. I mentioned that in my dividend video last year. Pretty much have all of those holdings still. Now, the other positions that are actually a little bit more interesting, I would say, is something like CrowdStrike. So CrowdStrike, I started buying this once it dipped below $100 a share. I think this has some great potential long term. So this is in the cybersecurity space. It's one of the leaders in cybersecurity. The reason why I like this is because the industry as a whole, cybersecurity, is one of the fastest growing industries in the world. Year over year, it's growing very, very quickly. And so there's massive demand for this. It's only going to increase. And I really like the leadership of the company. I've met some people who work at the company, and I think that it's run very well. And so because of that, I started to buy up this stock. Now, luckily I didn't buy it last year because it was flying high at around $250, almost $300 a share. Today it's sitting at about $100 a share. So once it got down to this price, I started to buy. This is very much a long-term play because I think it's probably going to go down further if we enter into a deeper recession. Because when you look at the actual fundamentals, it could have a lot more room to fall. And it does look a little bit overpriced now, even at $100, but I don't want to miss my opportunity. So I started averaging into it. Of course, if it starts running up immediately after this, then I'm not going to buy any more. But if it falls down to 80 or 70 or 60, I'm probably going to start increasing my buys as it goes down. And once again, I'm going to say this 10 times in this video. This is just personally what I'm doing. Please don't act on this simply because I'm investing into this. That would be very foolish. So I have some tech companies in the mix. I have some dividend stocks in the mix. And then I have this other sort of small thesis that I've built out over the past couple of months, and could certainly change. But I think that commodities and industrials, if you look over the past 15 years, they've been massively underinvested into. Last year, I invested into energy basically at the top of the bubble. Got kind of lucky there and basically doubled my money in the energy space when I got in like December and January of 2021 going into 2022. I've since closed that energy position, and I'm in pretty deep on industrials, things like US Steel, and actually even some mining companies, because I really do think that they've been so underinvested into. And I think the part that some people are missing, and I could totally be wrong on this, but I think the part that some people are missing is that everyone's looking at this upcoming recession, which is almost definitely going to happen, and they're assuming it's going to play out like how it played out in 2008, 2009, where we had this massive credit bubble that popped and we entered into this big deflationary period, and things like commodities, although they did have a bit of a run-up actually after the crash in '08, they still lasted for a couple of years. They ended up going to this really bad, we had this massive supply glut during like the 2010s, pretty much all of the 2010s for commodities. I don't want to go too in the weeds here, but I think it has a really decent setup. That combined, so the undersupply in pretty much everything, and this is why I have US Steel in my portfolio. I've held them for over a year now. But the massive undersupply combined with the likelihood that the US dollar, is, I think, going to decline further in 2023, I think is a pretty decent setup. Now, those two combined with one other factor here, that I think we're going to enter into sort of a mild recession and that demand is not going to completely fall off a cliff. If you combine those three factors, then I think that industrials and commodities can have a pretty good setup for 2023 into 2024. Now, if any one of those factors goes wrong, like the dollar gets really strong or we enter into a really bad recession, then I'm pretty much screwed on those positions and they're probably going to lose like 50%. But US Steel and some of the actual metals miners like copper miners, silver miners, and gold miners, I think have a decent setup if those three sort of factors play out in the way that I think they will. So yes, there is risk in that, but I think that people are kind of underestimating it at the moment. All right, time out. Just have to do a little shameless plug here. Don't forget to get your free stocks on Moomoo. So if you want to start investing in the stock market, you can sign up for an account down below in the description. You can click on the link and you can get free stocks. I think they're giving away up to 15 free stocks on the platform, depending on how much you deposit into the account. So I'll leave that link down below right there. If you want to get some free stocks, it's kind of a win-win situation. It's kind of a no-brainer. So check them out, Moomoo. Thanks for doing this little affiliate sponsor, and let's continue on with the video. Okay, now I don't want to sound like someone who's going all in on gold, but I think that even something like the price of gold right now at the moment, it's sitting around $1,900 an ounce. It's been running. It was at like $1,650 back in the fall, so it's already had like a few months of running up. But I think where we're at this point, where the Fed is kind of topping out at around 5% Fed funds rate, once they start dropping those rates, I think we're going to see gold prices increase marginally, not like massive increases. It's not like gold's going to go to $10,000 an ounce or something. It doesn't move like Bitcoin. But I honestly think that I wouldn't be surprised to see gold hit like $2,300, $2,400 an ounce in the next 18 months if the Fed starts slowly cutting back rates. Now, if we enter into a hard recession, then yeah, gold's going to go down, back down to like 1,600 or something. But I think it has a decent setup, and that's why I'm in some of the miners like Barrick Gold. There's a lot of different gold miners. I might honestly just shift into like some of the mining ETFs, just so I don't have to worry about like individual company risk. But that is one of my larger positions for this year, and it's basically neglected. And sometimes I think you have to sound a little bit crazy with some of your positions. Like, who's investing into mining companies in 2023? It sounds kind of stupid because you have Apple, you have Microsoft, you have all these like cool, flashy tech companies. But I think that's where some of the best value can be sometimes when nobody's looking in that direction. They've kind of written it off. And that's kind of what happened with energy. Like if you invest into energy 2 years ago, you'd be up well over 100% right now. And so it's just a position that I want to have in my portfolio. Now, besides those, there are some other companies that you have to forgive me, but I can't mention in this video because they're just too small of companies, and I'm trying to acquire like larger portions of them. And if they're under basically like $1 billion market cap, I'm not going to talk about it on this channel because I don't want to influence the stock price of small companies. I don't think that'd be very fair. So besides those individual stocks, let's talk about some other things that I'm investing into. And there's really 3 other areas that I'm investing into. So one of them is the venture fund that I have with Ask Sebi. So we launched this almost a year ago now, and this is something that I really absolutely love. It is a fund that is focused on early stage consumer facing tech, so pre-seed and seed companies. These are companies that I believe have the potential to change the world. There's a lot of potential upside, of course, also risk in investing in startups. I've done a number of angel investments in the past. Sebi's done a lot of angel investments in the past. We teamed up, launched the fund. We've been pretty quiet about it. I don't really, like promote it or talk about it very much. It is a 506c, so I can talk about it if I want to. But yeah, I've been funneling a bit of money into that, quite a bit of money into that on a quarterly basis into that fund. A lot of our LPs on that fund are actually influencers. So I think like between all of our LPs or the people who are investors in our fund, they have like 30 or 40 million followers or something along those lines. And that's very much a long-term play, because when you invest into early stage companies, really the time span is anywhere from 3 years to 10 years, sometimes even more than 10 years from when a company, you seed a company or you go into the pre-seed round to when it actually has either an IPO or some type of acquisition, it gets bought out, or it starts paying dividends, which doesn't really happen in the world of startups. So it's very much like long-term, probably not going to see returns on that for many, many years, but it's a great way for me personally to diversify some of my assets. Now, there's 2 other things, and the other one is investing into land. This is actually probably the one that I'm most excited about this year in 2023, is buying plots of land with my brother and then either harvesting timber on it and doing select harvest, not clear cutting because that's terrible, but actually select harvest where you go and you thin out trees. It's actually healthier for the forest as well if you understand rainforest management. I've learned a lot about that, read a lot of books. And you can actually cash flow with this. So you can do timberland or farmland as well. If you own 100 acres of farmland and you can lease this to a local farmer for sometimes over $100 per acre per year. So if you have 100 acres, you could potentially lease that for $10,000 per year that you could have cash flow coming in. I like this over traditional real estate because I just think that like residential real estate investing or commercial real estate investing, I think it's a little bit flooded. There's so many people and everyone's looking for deals. Everyone's buying up houses. And also it's just not really my cup of tea. I have a lot of friends who do it and it's really interesting, really fascinating, but I can't do everything. And I think I'd rather focus on farmland and timberland instead of traditional kind of real estate. So that's something I'm super excited about, and we're going down into West Virginia this summer to look at some pretty large properties, and hopefully we can buy maybe a couple thousand acres this year and set it up and have it running and hopefully cash flowing. Cap rates are pretty low, like 3 or 4%, but it's still something that I think is gonna be pretty good. Okay, now if you're thinking about investing into farmland, but you don't want to go out and buy like 100 acres, like actually buy the physical land, you can invest into it through a syndication like Acre Trader. So I've worked with them in the past. I'll leave a link to them down below in the description as well. But this is a platform that allows you to invest into farmland and timberland, other various plots of land, and they basically do a lot of the management for you, and they take a pretty small cut. You can read all about it down below in the description. I think it's pretty interesting. And then the last thing that I'm investing into is small businesses. I have friends who are starting businesses and they need some startup capital for it, and maybe like they're starting an e-commerce business or they're starting a YouTube channel or a blog, and they're looking for someone to help fund that. And so I do some of these smaller deals, not like the venture capital deals, but more so of just like small business deals where I will fund people or I will lend money to people. And that's just, something that I have been doing kind of on the side. It's like I have some companies that I have some equity in. Maybe I'll buy 10 or 20% of a blog or 10 or 20% of a YouTube channel, and then just get quarterly distributions. And it's kind of just another way, once again, to diversify. Oh, and one other thing that I forgot to mention is that right now, money market accounts or even high interest savings accounts are paying over 3%, sometimes 4 or 4.5% annual interest. So honestly, I might just park cash in there as well. I don't really see any problem with that. And for individual stocks, for example, I'm pretty heavily concentrated in specific companies, but if at any point I kind of lose a thesis or I'm not really sure which way the markets are going to go, I just pull out and put a lot of it in cash and just have it sitting in like a high interest savings that nets me 3 or 4%. And I have no problem with that. I would rather do that than just kind of gamble my money and just kind of hope for the best. I'd rather develop kind of a strong thesis on something. So that is the video. Thanks for watching. I hope you found some value in it, and let me know what you are investing into in 2023. Go ahead, follow me on Twitter, Instagram, and I will see everybody sometime in the future. I have no idea when I'm going to make a video next. Maybe next week. Actually, yes, because I'm putting out a bond tutorial next week. It's going to be super boring, super long, but for anybody who wants to watch it, I think it's going to be very, very valuable. So thanks for watching, and I'll see you next time.